Good morning, guys, and welcome to your market report. Today is Friday, October 26, 2018, and I'll tell you what, real estate. I'm going to show you some pictures. I'm going to put them up right here in San Francisco. Now, this is a house, if you can call it a house. It's really only the size of a small garage. Or a shack. Let's call it a shack. This shack in San Francisco is $650,000. Now, what the point I'm getting at is, if this tiny little shack is $650,000 US, how much money is stored, like stored energy, in all of the real estate in the whole sprawling of San Francisco? I mean, an awful lot of houses are worth an awful lot more. If this is the cheapest house you can buy in San Francisco, how much stored money in home equity and in also businesses and everything else, stored money is in that entire area? This is the same here in Canada and the same everywhere. The real money that's stored within the banking system, the bank has got their tentacles into the real estate markets, and an awful lot of the equity involved in these real estate markets is like stored money. If you see a crash in the real estate markets, that same crash can take down the banking system more than anything. And that's the reason why the 2008 crisis was such a crisis, was because of this energy that was stored in real estate, that they were doing the subprime. What they were doing was they were bundling mortgages together and everything. And then what they were doing is stamping them AAA so that they could be sold as AAA. In other words, AAA is your highest rating of something that is to be guaranteed you're going to get your money back, like a AAA. And they were stamping these bundles of mortgages, bundling them together. And a lot of the mortgages inside these bundles were subprime. They were people who basically shouldn't have been buying a house because they didn't have a good job or whatever. They were just letting them in there, opening the door to them because they wanted to move this real estate, and letting these people buy this stuff that had no business buying it. And then later they had to default on these subprime mortgages and stuff, and these were in the bundles of AAA. It was all scam. They were all pulling these scams. The bankers were all pulling these scams because, why? Is because they could. They do it because they can. And they've found a new way now of doing the whole subprime all over again now, and they've been doing this for about the last 2 or 3 years. They've built up a massive real estate bubble again in the United States, and if you don't believe there's a real estate bubble in the United States, just look at this shack for $650,000. Anyway, let's move on with the markets, What we got here is, first we'll start with the Dow Jones. Today is down 254 points. Okay, so let me start the charts right here, and let me open this chart up, and we can take a look at the Dow. The Dow is down 254 points. I mean, we had a little bit of a rally yesterday. We've been in, and we've been staying in the dead cat bounce. We're in the dead cat bounce right now. It's not over yet. We haven't really run into the big slide yet. And I don't think we're there yet. And the reason why is the bond market. We've lost a significant, in the bonds, we've had the bonds go down quite significant. Well, that means the price of the bonds are going up. We've had a little rally in the bond market. And this is giving me an indicator that this little selling spree in the Dow Jones right now, I'm not so sure it's going to be sustained too much longer. But that doesn't mean the Dow is going to go into a rally either. I don't think the Dow is going to rally. I just think she's going to level off for a little while, and the volatility is going to settle down for a little while But this is a tremor. These are tremors for a major earthquake that's coming. Now, what'll happen is after the Dow settles down, I'm expecting the bond market to start creeping back up again. This is what I'm expecting. This was been a tremor, and I think this tremor's just about over in the markets. The volatility, and we're only going to have rest for a little while because those bond rates are going to creep up awfully fast again. And as they start to go past on the U.S. 10-year, because the U.S. 10-year is what every debt is based on. Everything's based on the 10-year. As that 10-year starts to get up and creep back up again, that's the head point, 3.4%, passes to 3.25 and starts to head up. That's when we're getting ready for the big crash, guys. That's when we're getting ready for the big crash. It's coming. Be patient. It's coming. I'm surprised it's held off this long with the Fed pulling $50 billion a month of liquidity out of the system by not rolling over. Or I should say they're rolling over their treasuries and they're cashing them in. Just basically the treasuries are maturing and they're not rebuying them again. They're cashing them in and they're taking the money, and I believe they destroy the money. $50 billion a month, and that liquidity is being drawn directly out of the system. And that, to top that, raising interest rates. And they're starting to get up to the level now. See, for a long time they were raising these interest rates a quarter of a point, which is 25 basis points, and they kept raising it. It's like little nibbles, but those little nibbles add up. And we're starting to get to the point now where the little nibbles are adding up to a big chunk. And it's starting to have a real effect, a real honest-to-God effect. They're not going to get away with too many more rate hikes before this system's coming down. Where everything's starting to come together now to bring the system down. And that's why we're starting to see this volatility in the markets. Because everything's starting to come together. It's all starting to congeal. So let's move on to bonds and rates today. And we see what's happening in the bond market. We see that bonds are down to the U.S. 10-year, which is the one I watch like a hawk. Its yield is down to 3.079%. So these people that bought in at 3.25 or close to it, into the U.S. 30-year and U.S. 10-year and U.S. 5-year, they bought in at these higher rates. They're feeling pretty good right now. They're saying, hey, I was pretty smart buying those bonds, because look at the rates now. Ha, 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 ha. I'm going to tell you, they won't be laughing for long. They're not going to be laughing for long. Anyway, let's move on to the Bitcoin price today. Bitcoin is very stagnant right now. Stagnant, and it's not really going too much of anywhere. We're looking at a price at Bitstamp of 63.9425 today, and we're looking at pretty much a flat line. It's not doing much of anything, so there's not a whole lot to talk about. Let's move on to cryptocurrency market capitalizations. We're looking at $209 billion, 53.7% Bitcoin dominance. Some of the coins are up, some of the coins are down. It's very stagnant right now. There's not much going on. I'll have a lot to report about this because there is going to be a lot going on here in this market pretty soon. Now we're going to take a look at the silver price today. Silver is doing rather well today, and I'll tell you the reason why I say that. Holding its own today is because the dollar's on a charge. So silver is at $14.65. It's up 4 cents. That is actually good considering what the dollar's doing. So if you've got gold and silver, let's take a look at the gold chart. If you've got gold and silver holding their own, and gold's holding its own too. In fact, it's up $2.30. If you've got gold and silver holding its own, when you take a look at the dollar index, and you've got the dollar up today, an up day for the dollar, it's almost up to 97, and it's been on a charge, and gold and silver have been holding their own, this is a bullish sign for gold and silver. The fact that the gold and silver don't slump when the dollar's up. That's a bullish sign for silver. That's good, and so what do we got here? Do we cover everything? No, we haven't. We haven't covered oil today. And, you know, oil, of all these things that I talk about in the markets here, oil is probably the one that's least understood by the people, and it's probably the most powerful, most potent market indicator. But OPEC has got such a tight control over the price. And the thing is what we're going to see in the times coming. And also, there's another reason why oil is such a profoundly powerful market indicator, is because they don't call it the petrodollar for nothing. The whole underpinning of our financial system is all based on oil. It's not based on gold. It's not based on silver. It's based on oil. Oil is the commodity that is the grease that, and it's not going to change anytime soon. I know you got these guys coming out there saying, "Oh, we're going to go solar and all this kind of stuff." Yeah, we are going to go to alternative energy sources eventually, but everything is geared up for oil, and this is going to take a long time before that changes. And there's a lot of oil out there, and that's been discovered. There's enough oil to last a long time, but that oil is at higher prices. They're going to need more money to bring that oil and draw it to the marketplace. And so what's going to happen is, as that oil price slowly rises, and they get more money per barrel to bring that oil to the marketplace, the dependence on oil out there is going to lessen, and the alternative energy sources are going to flourish more. And the use of oil is going to slowly, very slowly, as time goes by, diminish. And the alternatives are going to increase. Things like electric-powered cars and so on. But it's going to be a slow process, and it's not going to be quick, and it's going to take quite a long time. But we are going to get there in the end, to where our use on oil is diminished, and the oil price is higher and higher and higher. And people, you're just not going to have things like, if you go out and buy a new lawnmower, it's not going to be a pull-start gas lawnmower. It's going to be something that runs on maybe electricity off of some sort of a battery charger that you put it in the sun, and you let your lawnmower charge up. Stuff like that. That's what we're going to have. More batteries that have deep cycle and hold, or much smaller batteries. We're going to see much smaller batteries coming that hold much more energy. So your lawnmower will probably have a battery in it. And you charge up the battery from the sun. You leave the lawnmower sit out in the sun. And it'll be good for maybe a 10-minute run before the battery discharges again. Stuff like that we're going to see. But across the entire board, we're going to see stuff like that. So listen, this has been your market report for this morning. Thank you guys for tuning in. And we'll catch you on the next show on Monday. You guys have a real happy weekend. Enjoy yourselves. Go out and have some fun with the family this weekend if you can. I hope you can. Bye-bye, guys, and we'll catch you in the next show.